Today we're going to allocate income to partners in partnership accounting practice. First thing we have to know is that we allocate income from partnership businesses based on their partnership agreement. It can be very simple. The partnership agreement can say we split everything 50-50. Whatever we make, or if there's any losses, we just split it right down the middle. That would be simple enough. But it may be a little more complicated. It may say, well, let's give everybody a 10% return on the funds they've contributed to the business and then split the remainder evenly. Okay. Basically, you have to look and see what the document says. Now, documents can be very complicated, but they typically have one of the three classic things, and that's what we're going to study. The three classic things are fixed ratio, which is everybody gets a certain amount. It could be a ratio based on the capital balances, and capital balances change over time. Or it could be salary allowances and then allocate the remainder. Let's do each of them in order. First, fixed ratio. That means each partner gets a certain ratio defined in the partnership agreement, but it doesn't change based on the results of the business or capital that's contributed. For example, a partner gets 80% and the other one gets 20%. Doesn't matter how much money they put in or whether there's gains or losses from the business. Let's try one. Freeze the frame and see if you can identify the amounts that should go into each of the partners' capital accounts. Okay, so hopefully this was fairly straightforward. They split the income 80-20 and you knew how much of them contributed initially to the business. Be careful when I ask you a question about computations that you've made. I might ask for Andy's share of the income or Zoe's ending capital balance. So if you've done the calculation correctly, you want to be sure you notice exactly what number have I asked for in that multiple choice question. All right, here's a new example, a little bit more difficult. Fill this out, the gray areas. Okay, so here it didn't matter what the opening capital accounts or the capital contributions were. You still split the income evenly. Let's try now allocating earnings based on the capital balances of the partners. The first thing you got to do is go find out, well, what are their capital balances? And sometimes if it's not an initial year, you may have to do some computations to arrive at those capital balances before you can allocate income. All right, let's look at this one. So you have three partners that have given very different amounts to the business. There you go. Now we got to get the ratio of the capital balance to the total. 10,000 over 16, 5,000 over 16, and multiply that times the earnings and get the allocation that way. Salary allowances are a little different. Salary allowances are not salary expense. They're not employees. A salary allowance is a first dibs when dividing things up. So you first set aside this much and then you spread the remaining to the partners. Here's an example. Bill's going to get 5,000. Okay, let's put Bill's 5,000 in there. And then we're gonna spread the remainder. What is the remainder? Well, we have 20,000 allocate. We've done 5. We have 15 remaining. And we spread that among the three partners evenly. They each get 5,000. All right, let's shake it up a little bit. We're going to make it a little bit harder and see if you can still hang in there. We're going to do a combination and then we're going to allocate a loss. Let's do the combination first. Here you go. Freeze this and see how far you can get. Okay, there's your initial capital balances. There's the salary allowance. Now we've got to compute 10% on the capital balances. There you go, pop those in there. Now what's remaining? Well, we need to allocate 30,000. We've already done 4,500 and 1,500. So what do you have left? You subtract the 4,500 and 1,500 you've already allocated from the 30,000, leaving you with 24,000 that you spread evenly to the three partners. Okay, it took 3 steps there to allocate that 30,000. All right, now we've got a loss. Let's see if you can figure out how to do this one. Freeze it, do the calculation, and then check. Okay, that was fairly straightforward. Now let's add another layer to it. Let us add a salary allowance. So now Bill's going to get a salary allowance, but we have this loss. So we're allocating a loss, but we just allocated a positive $5,000. So what do we have to allocate as the remainder to have the net be the total loss of $4,000? You have to allocate a minus $9,000, so the total allocated among the two steps is still the $4,000 loss. So we're going to spread that $9,000 to everybody so that ultimately we spread a $4,000 loss, but we did it in two steps, a positive step and then an exaggerated negative step. Try this one. All right, there's their initial contribution, there's the salary allowance, there's the 10% on the capital balance. What is X going to be? X has to be a number so that it nets out to the $4,000 loss. And then it's spread three ways.